Welcome to the weekly update, where I'll go over the action in the market for the week of July 31st through August 4th, and then we'll see how things look for the week of August 7th through the 11th. We ended up having a down week. On the weekly charts, we're still looking positive overall. We're turning more negative on the daily charts, and I'll try to point out the differences as I go through the charts. So far, things seem to be holding up okay. We're just looking at a pullback. On the daily side, we're just a little bit above critical support. If we break through that support and start to fall below that, that could turn things more negative. We're still in a seasonally weak time of the year. The end of July into August and possibly even to the end of August or beginning of September can sometimes be pretty weak seasonally. And that's what we're seeing played out as of right now. This can always change, and then we can adapt to what we see changing to the new scenario that we develop. A few things to bring up before I get going on the analysis of the charts, and I am trying to rework the daily video update thumbnails. Not the condensed version, but the longer version of the videos. I've been getting some feedback from some people that are supposed to know about these things, and they don't like the thumbnails, so every day over the last week, I've been trying different thumbnails. I've posted those on the YouTube community tab. If you want to go in and look at those and give it a like or a dislike, if you have any comments that you want to make, that's fine. Please feel free to do that, and I would really appreciate it. Also, I'm thinking about possibly doing a live course at some point in the future. We're probably looking at September-ish or so. I'm working on the different areas that we'll be covering, and I don't really know how long it will be. What I'm trying to find out right now is whether there's even an interest for that or not. It would probably be a live class that I use Zoom, and then you would come into a Zoom room, and we would go from there. It would also be recorded in case you can't make it, or if you want to re-watch some of the sessions. But just let me know what you think of that, if that's a good idea or not. I'm also going to start announcing this in the daily video updates. I do have a PDF that's available in the description below every video that I post. I do have a condensed version of the daily video. It's about 12 minutes or so now. That's what I've been kind of averaging lately, where I just break down the major things that are happening on the daily basis. Typically, the full-length version of the video is about 30 minutes. I know that's only about 18 to 20 minutes different. Hey, when you're really busy, 20 minutes can mean all the difference. I do have a private Facebook group that you're welcome to join. I'm still pretty much the only one posting anything in the group. I'd like to get a little more back and forth going on, but if that interests you, just send me a request and I'll let you right into the group. I'll also be posting a new poll after I get finished doing this video. YouTube comments, I'm really trying to keep a close watch on those. I want legitimate comments to be posted. I don't get a lot of comments, but the ones that I do are important to me, and I want the bot comments and the crap comments to go away. Just as an example, I had somebody post a comment and I can't even see it, and I own the channel. It must have been some kind of a bot comment that is being prevented from being viewed. In case you're interested, I also post the videos on Rumble. I use that kind of like a backup channel in case something happens to YouTube. The inverse of that is also true. If something happens on Rumble, you can come over and watch on YouTube. Here is the link to the channel on Rumble. As I just mentioned, I am working through the thumbnails, and I already talked about that. Incidentally, I've been having some issues with the power unit on the computer that I use to do these videos. So far, it's been holding up. I'm hoping it'll get through the rest of the videos this weekend, and then I can try to take care of this problem earlier in the week. Let's go back and talk about this week's session. For the week, we ended up being down 2.27%. Volume was about average. There were a couple of days when we went higher and lower, but we still stuck to about average overall. We're not seeing a real increase to the upside or even to the downside. Of course, a lot of that can be explained by it being the summer and a lot of people are gone. We're also in kind of a tenuous period of time for the market right now where people might be a little apprehensive to put new money to work. As far as what the market's fixated on right now, the technicals are positive on the weekly charts. We are negative in the short term on the daily charts, but we're also oversold. We're also negative in the intermediate term, and we're not oversold. We're still looking okay in the long term. I'll go through the charts here, and we have some positive things and some negative things to be aware of. The market is completely fixated on inflation and interest rates, and that was the real catalyst this past week. We had Fitch come out and downgrade the U.S. debt, That really took the markets a little bit by surprise. We had been seeing on the daily charts a lot of negative things that almost started to come together, but not quite. Well, when Fitch made that announcement, we saw everything come together and we had a difficult week. And we're trying to determine right now, is this just a seasonal pullback? Are we going to go down and be able to buy on the dips, which is something that I never do. I wait for the charts to reinforce what I want to do. And we're also dealing with earnings season, and that can be really influential as different companies report. The condition of our trend, we're still positive on the weekly chart. We're positive on the daily chart, but the trend is starting to weaken. The green line is starting to come down. The red line is starting to come up. We might be switching over to a negative trend soon if we see more follow through to the downside. For the week, the Dow was down 1.1%, the Nasdaq down 2.8%, the S&P down 2.3%, and the small caps, as denoted by the Russell 2000, were down 1.2%. Here are some highlights that happened over the week. There were numerous earnings reports that were released, and some of them were pretty influential on the market, including Apple that ended up being down and Amazon that ended up being up. And there were just a mass number of other earnings reports, but these can really impact the market. Interest rates rose, and this put pressure on stocks, which were also coming to an overbought condition on the daily charts, so to see a pullback is not a real surprise. Strong economic data also supported the view that the Fed is likely to keep rates higher for longer and that they might even raise interest rates somewhere down the line. This got into the positive scenario that the market had been developing and working off of that was leading us higher, that the Fed was almost done, and that earnings growth going forward was still looking positive. Well, that scenario is kind of getting pushed aside right now and being replaced by more of a negative scenario. Fitch did come out and they downgraded the U.S. credit to AA+. Their highest rating is AAA. And the reasons for that are fiscal deterioration over the next 3 years, growing government debt, and an erosion of governance. You can take this a lot of different ways. This is just what they came up with to justify their downgrade. The employment situation still remains strong. We had the employment situation report on Friday. The monthly jobs report did show a little bit of weakness, but still strength in the longer term. The ADP private sector payrolls were up really strong, and weekly jobless claims are continuing to weaken as we look at the 4-week moving average of that chart. Growth has slowed according to the ISM non-manufacturing index. It came in lower than expected. Looking at the poll results for the latest poll, now this was posted a week ago, so some of this is kind of out of date and you already know what's going to happen. The NASDAQ 100 and the S&P 500 remain at long-term resistance. Do you think they will both decline from resistance, 42%, break through resistance, 33%, remain near resistance for the time being, 25%. So we're seeing a lot of discrepancy here, but most people thought we would see a decline, and that's really what's happening right now. The positive scenario continues, which believes that there will be a soft landing, that the Fed is almost done raising interest rates, and that future earnings look positive. Do you think this scenario will continue? 38% said yes, 63% said no, and that's the shift that I was just talking about. We're coming from this scenario and developing a little more pessimistic scenario. Then there was an increase in interest rates this past week. Again, this was a week ago when the Fed met. Do you feel that interest rates will keep going up? 67%. Nobody thought they will decline. 33% said they will stay about the same. The last question, the S&P 500 continues to hold up in spite of being slightly overbought and coming into a seasonally weak period, and I love how I spelled the word weak here. Do you feel the S&P 500 will hold up and go higher, 36%, break down and decline, 36%, chop sideways, 29%? We ended up declining on the week. Looking at some Isabel Net blog charts, here's the first one showing how much money is going into money market funds. Now, it doesn't always mean that they're going to put this money into the stock market. It just means that banks are not paying anything as far as interest rates are concerned, so people are taking their money out of banks, which also seem to scare people these days, and they're putting it into a money market fund where they can get a higher rate of return. That just makes good logical sense. We look at valuations for the S&P, and I'll also deal with this in the intermarket analysis video. We're above the 1 standard deviation when we look at the long-term average. That's the dotted line. When we go above this yellow line, that means we're starting to get expensive. And what they do on this is they look at the trailing 12 months, so earnings that have already happened. They look at the forward PE ratio, earnings that are based on projections that haven't happened yet, and then the 10-period PE ratio, which is more like the Shiller PE ratio that we look at. The insider transactions ratio, this is legal insider trading. There's a legal kind and there's an illegal kind. This is the legal kind. We're pretty much neutral currently. Heavy truck sales. If we were getting ready to really decline economically, would this chart continue to be going up? Probably not. It is showing a real continuation of strength. Tech inflows are back to accelerating. This is kind of the place to be. When we see a lot of inflows, that helps to boost up the market. But we have to be careful of that because a lot of folks that are doing this, they're reacting to what's already happened and they end up arriving late at the party. But for right now, it's still looking positive when we look at the raw score for the flows and then the 4-week moving average of the flows. Earnings estimates continue to look positive going out into the future. I put the red line on here. Whether you're Morgan Stanley, which is the dark blue, or the consensus, we're seeing a gradual continuation of projected earnings growth going up into 2025, and this justifies stock prices going higher. This is a little bit of a concern. This is all employees and temporary help. We're dropping below this red line. And sometimes when we drop below that before, you can see the gray area. That's right as we were going into a recession. Now we have the whole COVID plunge here, and that was kind of its own deal. We're wondering, is this going to start to show some improvement, or are we going to continue to fall? We're not really seeing any weakness right now in the reports that we're receiving. We'll have to see if that changes going forward. Energy, which was the place to be in 2022, has been really getting hurt in 2023. It got down to the point where it's well below the 1 standard deviation. It's starting to come back up, but it hit this 0.4 level and it's then been retreating. It still says that they're historically low when we look at energy compared to consumer discretionary. Pre-election years tend to peak near here. This comes out from Carson. We're into the latter part of July and now the beginning of August, where we see some historically weak times. Historically, this has bottomed out in August, and we tend to see some improvement going into September. FactSet earnings blog. Earnings are running amok right now. The S&P 500 companies with more international exposure are reporting an earnings decline of 21%. The blue area right here, this is where they get greater than 50% of their revenue just from the U.S. They're holding up. All of the S&P 500 companies are reporting a decline of 7.3% as far as earnings growth. But when you look internationally, they're seeing almost 21% decline when these companies have more international exposure. Here's another chart showing the revenue growth where it's still positive for the companies that are focused more on the U.S. We're seeing almost no advance when you look at all the S&P 500 companies, and more of a decline when they get more than 50% from international exposure. Another pie chart here. Here's international. That's 41%, where U.S. stocks are 59%. Then on Friday, they posted another update about earnings. It says overall, 84% of the companies in the S&P have reported their actual results. Of these companies, 79% have recorded results above estimates, which is above the 5-year average of 77% and above the 10-year average of 73%. This number also marks the highest percentage of S&P companies reporting a positive surprise since going back to the third quarter of 2021. When you take it all together, companies are reporting earnings that are 7.2% above estimates, which is below the 5-year average of 8.4%, but above the 10-year average of 6.4%. Yeah. Now let's go back and look at our charts and analysis. Here is the intraday chart going back to Monday, where we were pretty much flat. We had a lot of economic news coming out. We had some things happening in the market, so it was pretty slow overall. Both in Monday's session and in Tuesday's session, we really gapped lower on Wednesday, and this is when things really started to get kind of ugly. We actually came down to S3 and S4. I had to put these levels on here. The software that I use for this doesn't even calculate that. Luckily, we didn't go down to S5. I don't even know how to calculate that one, but this was a pretty negative day. Then on Thursday, we gapped lower and then spent a lot of the day trying to come back, only to see late day weakness. It looked like Friday was going to turn into a really good day. They liked the job markets report. We gapped higher, came down, filled the gap, tried to go higher, and then about halfway through the session, we just saw systemic selling, which took us negative down below S1, and we closed near the low. So we closed near the low for the day and also for the week on Friday. So for the week, all of our different indexes ended up being down, with the NASDAQ and NASDAQ 100 being down the most. Year to date, we have the NASDAQ 100, the NASDAQ, which are doing good. The S&P is in third place. All of our other indexes, even with the decline, continue to be positive going back to the beginning of the year. Going back to the all-time high, all of the indexes still remain negative, with the small caps in the rear, followed by the NASDAQ. Looking at different sectors, and this is for the whole week, going Friday to Friday, we were negative overall, so I sort this from what was down the most: utilities, which have been under a lot of pressure lately, and tech and communication. These are areas that have seen some favor. Not utilities, but tech and communication. There was one area that was down, which is an area that's really been suffering in 2023, and that was energy. When we look at our RRG graph, or our relative rotation graph, we see that discretionary is pretty much doing the best right now. That's a little bit of a surprise. It has been showing some improvement. It's been one of the stronger sectors in 2023, but after watching it in 2022, it's like, my goodness, I thought this would never happen. We are seeing a trailing off of tech and communication. These are the stronger, big growth companies that have really been leading the market higher. They're now starting to show some weakness. We do have some other areas that are continuing to be red and they're lagging behind, but we're also seeing more broad participation of other sectors that are starting to improve. Energy, the financials. We just had a golden cross in the financial sector, believe it or not. Materials, industrials. These aren't real exciting things, but to see these starting to show some improvement gives us some hope in the bigger picture that things are looking a little bit better. For the week, and this is just the 5 trading days of the week, we look at the sectors. All of the sectors ended up being down. Energy was up, but that's Friday to Friday. I just go Monday through Friday on this chart. Going back to the year to date, communication, tech, and discretionary. These are the areas that have been leading, where healthcare and utilities, even though they were up on the week, are continuing to be down the most so far in 2023. Going back to the all-time high, energy continues to be positive, followed by industrials, and then all of the other sectors continue to be negative. Looking at sentiment, we were getting kind of extreme, but by Friday's session, we got down to where we're still positive. Here's the historical chart. We got up above 75, and that's usually a warning sign. We dropped down, then things were looking a little better. We came back up, but with the declines that we saw, we're dropping back down to positive. Looking at the active asset managers chart, and I have this chart and then I have the chart from their website, and I'm seeing a discrepancy between the two. This is actually the reading from a week ago. What's more accurate is the latest reading right from their website, where they came down after being above 100, and now we're seeing a reading of 78.46. Now going back to this other chart, these are people with emotions, and what these active asset managers do, their biggest goal is to beat the indexes. And if they're lagging behind, they have to start jumping in whether they want to or not, because they have to try to beat at least the S&P 500. And so when they start to get extreme positive, we use this as a contrary indicator, even though these folks are professionals. So we are seeing it drop back down as things are coming more down to earth. Looking at the VIX, we did see a spike up, especially later in the week with the line chart as well as the bar chart. But overall, we're still getting a rather low reading. We just have to look at this on a relative basis where it had already been low and then it's starting to come back up. The Ulcer Index, another gauge of fear in the market, it ticked up just slightly and it's going up a little bit on the daily chart. The bear to bull ratio, we're seeing this decline overall because folks tend to follow what's already happened. Now this chart was updated on Thursday. We'll have to see if we see a spike up in folks going from the bullish side back over to the bearish side. The active asset managers, after getting up to this 30 level, they drop back down. A week ago, we were having some trouble. They also tend to react to what's happening. We also keep an eye on this red moving average where it is advancing, but it's still below zero. Then we compare cash with the tech sector. It's still looking okay. Now, this is counterintuitive. As this black line is going down, that means tech is outperforming cash. Well, when we got into 2022, cash was outperforming the tech sector, and then we've been dropping back down. And so even though this is ticking up slightly, we're still looking good in the bigger picture. Looking at the economy, we have the latest reading from the Atlanta GDP Now estimate. They're coming in at just a little bit under 4%. When they look at the top 10 and bottom 10 forecasts, we're at about 1.5% to the upside and about maybe being down 0.5% to the downside for GDP. Here's a graphical representation of that where we're still looking positive when we look at GDP. That's one of the definitions. When GDP goes negative for 2 straight quarters, that's one part of being in a recession. Looking at the spread between risky and not as risky bonds, when this ratio is going down, that means that there's not a lot of fear. When we get concerned is when this ratio really starts to go back up. It ticked up slightly, but it's not really rising with any conviction right now. We also keep an eye on the correlation, where the S&P 500 is not correlating to this spread. The latest reading of the Financial Conditions Index, we're below this black line. When we get nervous is when we go above the black line. Then we have some other charts that have finally been updated. These are the tightening standards showing that banks are getting more stingy, who they're lending money to and how they're lending money to them. That's a bit of a concern and that can drain on the economy. Then updated in August, we had the real-time SOM Rural Recession Indicator. We only get really nervous if we go above the red line. We're barely above the black line. Also updated was the U.S. recession probabilities on a smooth basis. We only get nervous if we go above the red line. We're just barely above the black line. The Brave Butters Kelly Leading Index. This is a little bit of a concern, but it is rolling over. We're above the black line, but if we really start to spike up, that'll make us more nervous. The fact that we're flattening out lets us feel a little more comfortable, at least for right now. Looking at inflation, this is the Inflation Now casting. We started a new quarter, so that's why we're seeing not very many things in the chart. We will be getting CPI and core CPI in the upcoming week. A week ago, we had the PCE and core PCE, and it's showing that inflation continues to decline, but these adjust on a daily basis. Where's the Fed at right now? Most of them are on vacation. I went and looked at their calendar to see when they were giving speeches, and a week ago it said nobody's giving any speeches, so I thought everybody's going on vacation. It turns out this coming Monday there's one speech by one of the Fed governors, but that's the only thing. As far as what is the likelihood of what they're going to do at their next meeting on the 20th of September, there's an 87% chance that they're going to keep rates the same. This was as of the close on Friday. Now, this is going to change many, many times as we get closer to that meeting. Here's how we see how it has changed. The current reading is dark blue. Then we have a day ago, a week ago, and a month ago. And more folks are in that camp right now. And as we go day after day and we get all these economic reports, this will shift until we finally come up to the day of that meeting. The balance sheet continues to decline just as the Fed said it would. Here's the year-over-year change showing the decline in the Fed balance sheet. Looking at some breadth analysis, we're still positive based on price and volume, even though we ticked down with both this past week. The new highs, new lows, we're rolling over a little bit when we go back 4 weeks. We're already declining when we go back 10 weeks, but we have been seeing more new highs than we have been seeing new lows, but this is starting to trail off, and we're seeing that trail off on the daily charts as well. The advanced decline ratio, it is declining, but it's still above 0, so that is positive longer term. Accumulation distribution, and this was kind of a warning sign on the daily charts. We saw a drop below the moving average, and it stayed there for a few days, and then we saw the weakness after that. This tries to measure what is the smart money doing. We are seeing a decline right now, but we're still above the moving average. Looking at our trend, the ADX, where we're starting to turn down with the green line, but it's still on top. The ADX is still above the moving average and rising. On the daily chart, the ADX has dropped below its moving average. The green line is turning up slightly, but it's declining awful fast too. If we see more follow through downside, we might see a trend change on the daily charts. We also keep an eye on the Erin. The green area at the top, that's buyers. The red area on the bottom, that's sellers. The oscillator at the very bottom shows the difference between the two. When we're above 0 and advancing, that is positive. We had been getting an extreme reading. We dropped down a little bit, but we're showing some improvement. The mass index is not generating a signal right now. I still show this chart because it's part of my overall catalog of charts to show. We only get excited when we get up to the red line and the blue line, but right now we're far away. Some other charts that we look at. Here's the daily chart where we were having trouble breaking out above this upward sloping trend line. We hit resistance and came back down. One negative thing is there's a pivot level right here. We fell through that. It looked like we were going to get back above that. Then when Friday developed some weakness, we ended up falling down below that. You can see on a daily basis that we are pretty much below average with volume. Looking at our trend channel, we're still above the midpoint, even though we're declining. The pivot points, and this was a big one. I pointed this out a week ago. This ended up being a major deal. We came right up to this level a week and a half ago, hit this pivot point, and we've been declining ever since. I've also been pointing this out on the daily videos. So we'll want to keep an eye on this. This is longer term resistance that the market is running into. The 50-period simple moving average continues to be positive even though the S&P declined. The long-term trend is still positive. We're still above the 13-period moving average. The McClellan oscillator is declining, so this is negative. It's also getting down to an extreme negative reading. So when we look at the summation index, after getting extreme positive based on price, we're starting to pull back. When we look at volume, we are declining, but we're still above zero. Looking at the Swenlin trading oscillator, we're dropping below zero based on price and volume. That's more negative. The PMO is still advancing. When we look at the PMO itself, we're declining but still above zero based on price as well as volume. Then we do a PMO study. With the PMOs that are rising on the weekly chart, we're seeing that drop down, almost getting extreme negative. We're seeing the buy signals start to trail off, and we're seeing almost this exact same reading on the daily chart where we're still extreme positive, but we are declining. The bullish percent index almost looks identical to the daily chart. We got up to a very high reading, which suggests that there's good momentum. And what this measures are the point and figure buy and sell signals. When there's a lot of point and figure buy signals, this chart goes up. And the inverse of that is true. Well, we're starting to come back down. We're still extreme positive, but the fact that we're seeing declines on the daily charts and this hasn't really dropped more than it is a little bit encouraging. But beware, this could always pick up steam and really start to head lower. The Bollinger Bands are not giving us an extreme reading. It is declining, but it's still above the dashed line. Our oscillators are rolling over a little bit with the slope, but we're still positive across the board with our other oscillators. We have now turned negative on all of our oscillators on the daily charts. The Chaikin money flow turned negative and kind of gave us a warning sign. We're seeing a decrease here in the weekly chart. It is declining, but we got more of a heads up by following the daily chart. The Chaikin oscillator continues to decline, but we're still above the zero level. The force index also declining, but is still positive. The money flow, after giving us an extreme positive reading, is now starting to decline. The rate of change going back 1 week did decline because we ended up being down for the week. Going back 50 weeks, we're also seeing a little bit more weakness longer term. The RSI, after almost getting extreme positive, has been declining. The special K, on the daily charts, we are positive. On the weekly charts, we're showing a little bit of improvement, but we're still negative. The Stochk RSI, after being extreme positive, is now starting to decline. The Williams percent are also extreme positive and declining. The Kopic curve, and I know I spelled Kopic wrong. I didn't know there was a right way to spell it. We lost the Kopic curve buy signal on the daily charts, and we're starting to see some weakness here on the weekly chart. The ultimate oscillator, after being extreme positive, continues to decline, but is still above 50. The vortex, the green line is still on top, almost an extreme positive reading, and not much of a change in this indicator. When we look at our long-term fib charts and long-term moving averages, we're still hanging in there. We're still above this blue moving average. We're well above any of the retracement levels that we've been following in the past. So far, the market is holding up. Our different charts. We're getting more of a doji for the Heikin Ashi right now, which means we opened and closed at just about the same point. We've turned negative on the daily chart. The Keiki chart, it's still positive because it's black, but it's starting to point down. We've turned negative on the daily chart. The Renko is still looking positive on the weekly chart, turning more negative on the daily chart. 3-line break, positive on the weekly chart, negative on the daily chart. The equivolume, and the reason I include this in this section, the bigger these bars are, that means the more volume went into a particular move. On the bottom, we have the ease of movement. What is the path of least resistance for stocks to go up or down? On the daily chart, we're starting to cross below zero with our 14 period. Here with the 14 week, we're still looking okay. The point and figure chart had nothing new drawn. We're still working off of an ascending triple top breakout that was generated on May 15th. We're also working off of a breakout signal that was generated on the daily chart on May 18th. Our different trading systems. We're turning back to neutral with the Elder's Impulse system, and we're still positive with the parabolic SAR. We have now turned negative on the daily chart with a dot above for the last 3 days. That is a bit of a concern. The PPO, I usually would include this in the daily video, and I'm like, wait a minute, this is a weekly chart. I should be including it here. This is a momentum oscillator, similar to the MACD and other momentum oscillators. Long term, we continue to be positive. We're seeing a little bit of weakness in the intermediate term. Short term, we've started to drop below zero. That's a little bit of a warning sign. And I also wanted to include a few daily charts that you might find interesting. This first one I just started to add, where I went in and drew some trend lines. I'm not a big believer in all these crazy lines going all over the place. I want them to have some logic behind them. Because as I repeatedly say, if you draw enough lines on a chart, you can get it to say whatever you want it to say. So what I did is I went to the October 2022 low, and then I went to the March 2023 low, drew a trend line, and then sent it off into space. From the March 2023 low to the May 2023 low, I drew another trend line, and then we have a shorter one going from the May 2023 low up to the current time. One thing that's a little bit concerning is we broke below this other trend line that we had been above for a while. If we continue to fall, we're looking at potential support at right around the 44.50 level. We're also seeing a bit of a change here. We came up to the end of the 50-day cycle. We had a new cycle start on August 1st. That's about when we started to see some problems. So we're wondering, is this 50-day cycle going to end up being more negative? It doesn't mean we're necessarily going to go straight down. We just want to be aware of this. I also added the Dow to transports ratio. When this ratio is going up, and this is a daily chart, the Dow is outperforming. When this ratio is going down, the transports are outperforming, and that could be a good thing. A big part of the U.S. economy are the transports. If the transports are happy, the market tends to be happier. That can also help the S&P 500, suggesting that economic growth is starting to happen. So we want to see this ratio continue to fall. We're also keeping an eye on the daily chart of the NASDAQ. We came down to the 61.8% retracement level, which I have is at about 13,874, but please keep in mind I draw these fib levels myself. I don't use computer software to draw them for me automatically. I just have to eyeball this. We've been down to this point twice now. We closed a bit off of this level. Is this support going to hold? If we really start to fall below this, that could turn things more negative. We're also seeing support holding on the NASDAQ 100 chart. We came down, and right now, the August 2022 high is providing support. Are we going to be able to bounce up off of that, or are we going to continue to fall lower? Then also looking at the NASDAQ 100, and this is more negative, on the daily chart, we saw a negative divergence with the PPO, a momentum oscillator. Where price was making a higher high, the PPO is making a lower high. Now, please keep in mind, part of this is how it's calculated, because as price is going up, these calculations that were lower, they fall off, and you get higher numbers in the calculation, so that can produce a negative divergence. But sometimes this can end up being a self-fulfilling prophecy. We also saw more of a shorter-term negative divergence, where we were coming down and trying to go back up, but the PPO was continuing to decline. So this is more negative when you take it all together. We're also keeping an eye on the FANG index. It broke out recently and set a new all-time high, and then boom, came right back down. Now we're having a hard time getting up to the previous all-time high, and we're asking, is this going to cause some kind of a problem? We're also looking at the 3-month yield. This is a daily chart where last time we were at these levels was right before the great financial crisis. Well, we've not only gone above that, we're continuing to go higher right now. If this finally rolls over and starts to come down, we're wondering, is that giving us a warning sign? Now, let's go back and look at the broad market. Here's another new chart. This just shows from 2019 through 2023, the percent of the months in which the S&P closed higher than when it opened. I can't change anything on this chart, so I just kind of have to go with what's ever here. You can see that August tends to be fairly negative when compared to the other months. September tends to be even worse, so that's another thing to keep in mind. Looking at just a blank chart of the S&P mid caps and small caps, where we did see a decline with the S&P as well as the mid caps, but they're holding up a bit better. The small caps are also starting to hang in there, and a little bit they're starting to outperform the S&P. That could be longer term positive if that continues. Looking at the Dow, even though it was down over 1% for the week, it's still in an uptrend. The Nasdaq continues to be in an uptrend. The Nasdaq 100 is in an uptrend. Small caps are also giving us a recent golden cross on the weekly chart and continue to be in an uptrend. The mid caps are also still in an uptrend. The NYSE is also in an uptrend. The 30 biggest software companies, even though they broke down below this blue moving average, were still in an uptrend. Looking at all stocks, saw a little bit of weakness, but are still in an uptrend. FANG, after coming up to the all-time high, having a hard time breaking through that, but still it's in an uptrend. ARC also saw some weakness this past week, but continues to be in an uptrend. Looking at the Dow, transports and utilities, we're seeing the transport starting to outperform a little bit, as I showed before. That could be positive. We're seeing some weakness in the utilities. That could also be positive because when the utilities go down, that often gives good support to the S&P 500. Keeping an eye on the banks. As I said, we saw a recent golden cross in the financial sector. We're seeing some improvement with this bank ETF. It has been going up, even though it saw a little bit of weakness this past week. The RSI is above 50, but it's starting to decline. However, the MACD on the bottom continues to be positive. Looking at all deposits, we're seeing folks slowly but surely starting to put their money back into banks. Keeping an eye on the broad market, the CRB index is showing some improvement, even though it was ticked down this past week. However, it's still in a downtrend. Oil is starting to break up above 80. It's now at 82.82. Good luck filling the gas tank. Copper continues to chop a little bit. We're not quite at a death cross here, where we have seen a death cross on the daily charts. That's suggesting economic weakness going forward. When we look at the dollar, after coming down below 100, it actually had a pretty good week. It got up into the 102s earlier, only to finish in the high 101s. The gold index is still in an overall uptrend, both on the daily chart and weekly chart. We're seeing pretty much that same thing with silver. When we look at bonds and interest rates, total bonds are chopping more or less sideways. We're still in an overall uptrend. We're just barely hanging on to that uptrend for right now. The stock-to-bond ratio shows that stocks continue to outperform bonds on the monthly chart. The yields, after really going up earlier in the week, did see a decline on Friday. When we look at a weekly international chart, the UK still has the highest rates, followed by the US and Germany. We're also keeping an eye on Japan because of situations there. Their government is coming in and buying lots of their Japanese bonds at the full percentage point, even though they're a little bit over 0.5% on a real return right now. We're wondering if that's going to lead to some kind of a problem that will eventually feed over into the U.S. markets. We also keep an eye on the MOVE index, which did decline on Friday, but it has been going up. This is a daily chart. This measures the volatility of bonds. The VIX, which measures volatility of stocks, has been going up, so we're seeing the relationship getting a little bit more hand in hand with each other. Please be aware, though, that the MOVE index has only been around a couple of years. There's not a lot of historical data to pull from to do any longer-term studies, so I'm just trying to figure this out as we're going along. Looking at some relative studies. First, we look at intermarket analysis going back to the beginning of the year. Even though stocks have declined, they're up the most, followed by gold and oil. The dollar did see a decline, but is still positive. Then we had bonds drop down below zero, and they're actually turning negative going back to the beginning of the year. When we go back to the all-time high, we have oil in the lead, followed by the dollar, gold, where stocks and bonds are still negative. The Nasdaq to S&P 500 ratio is still in an uptrend, even though it weakened slightly. The S&P 100 continues to outperform the S&P 500. Gold is really having some trouble when compared to the S&P. It's in an uptrend on its own chart, but it's really underperforming the S&P, and we're seeing a death cross in this ratio. When we compare gold to the dollar, it's having a really difficult time breaking through any of this upper resistance. This is obviously an erroneous chart. I really can't use it this week. I hope they fix this, so we can't really evaluate the growth to value ratio, but based on what we saw last time, growth is outperforming value on the weekly charts. Bonds continue to underperform stocks. The low volatility stocks continue to underperform the rest of the S&P. Energy is continuing to underperform the tech sector, even though it did bounce back. Tech was down, energy was up, so we saw this ratio turn up slightly. Discretionary has been outperforming staples, and discretionary kind of held up pretty good this past week. Looking at our longer-term secular trends, which can be decades, and our cyclical trends, which are typically years, and then seeing how we look as far as our trend. We go to the NYSE breadth thrust. There was a signal that was generated in October 2022. We bounced up out of that, and that is still on the books. So if you watch the daily videos and I say the long-term setups and seasonality are still positive, this is one of the charts I'm talking about. I'm also talking about this chart, the ZWAG NYSE breadth thrust. In March, it got extreme negative, and then it immediately zipped up and went positive. That is a signal. That stays on the books indefinitely, and that is also in the background. Looking at the Zohorchak method, it continues to be positive. That's also in the background, long-term positive. Here's another weekly chart of the S&P 500 where we're coming back down below this resistance level. I went back all the way to the 1987 crash. That's where this line comes from. And we were able to get above that, and now we're falling below it, but it's going to take some time for this thing to work out. We also are seeing just about that same thing with the NASDAQ 100 weekly chart. We're just a little bit below this resistance level. I'm still calling it resistance until we break above it and say goodbye, or it'll remain resistance if we break below and continue to head lower. This is also another warning sign. We look at a ratio of the NASDAQ 100 to the Dow. When we had a really high reading, this was the top of the dot-com boom. Right after that was the dot-com bust. It then took us 20 years to get back up to this level. This was the end of 2021, right before we saw a very difficult 2022. Now, it doesn't mean it's going to go straight down. We're looking for the overall trend. We are starting to turn back down, but we could see some improvement here, or it could chop down a little bit and then start to go back higher. We don't know about that yet. All we can go with is what we see right now, and this is a warning sign to be aware of. Looking at the correlation between the weekly S&P 500 and the weekly DAX, which is the German index, where it's going back and setting all-time highs, but we're not setting all-time highs with the S&P. We're seeing the correlation between the two trail off a little bit. They're not following lockstep with each other like they have in the past. Some historical momentum studies. I only have the one chart to show because the other ones are just making the video too long. This came from the idea that when we broke above this trend line, were we going to stay above it? And what was the MACD doing at that time? On this chart, the MACD was right around the zero level, where other times when we saw a breakout above the trend line, the MACD was negatively diverging or it was outright negative. This time, it's showing some improvement, even though this past week saw some weakness. So this is longer term positive and also remains in the background. So what's our outlook for Monday? And this is just based on the daily charts. We will get a lot of earnings reports this upcoming week. There are no scheduled Fed speeches. Well, there's one there now, and it'll be on Monday, but it's not by Governor Powell. The technicals on the daily charts are negative, but we're oversold in the short term, and we're turning more negative in the intermediate term. We will only get consumer credit on Monday, and then we're keeping an eye on the geopolitical events, but for the stock market, it's about inflation and interest rates. Here's the updated calendar for the upcoming week. Please keep in mind that on Thursday we're going to get CPI and on Friday we're going to get PPI. The Stock Traders Almanac statistics for August 7th, the Dow is neutral to positive, and I don't know why that shifts over like it does. The S&P is also neutral to positive, where the NASDAQ ends up being more negative for that day. We're also keeping an eye on this. We're seeing seasonal weakness in the NASDAQ. Are we getting near the end of that now? Are we going to bottom out and start to go back up? Or are we going to see a continuation of the weakness? This is just the historical averages, and we use this as a guide. It doesn't mean that things are going to play out exactly like this, but to me, this is one of the best tools to use to kind of get an idea of where are we going into the future. And then we can adjust that as things change. Also, we will be on the 5th trading day of the month on Monday, where sometimes we see a little bit of a bounce in these dash lines. Those are pre-election years, where the figures I just told you from the Stock Traders Almanac, those are all years. So maybe we'll get a little bit of a bounce out of this because we're oversold in the short term, or we could still continue to see more weakness. Going back to 1950, we're 50-50 when it comes to pre-election years for the S&P 500. Tom Bowley from Earnings Beats, he's also part of StockCharts.com. He comes out with a free monthly newsletter, and he's saying, okay, how does August look? Well, at a glance, it's the third worst calendar month. Energy is not hot. Try to tell that to what happened in the past week. Where tech tends up being hot. Try to explain that over the last week. Well, often we see some strength in the first part of August based on his research, up 13.05%. Then we head into a time of more negativity. Then we get a little bit more positive from the 11th through the 17th. And then going into the latter part of the month, we see a little bit more weakness. At the bottom, he says, the relative strength of growth versus value lives in the period May through August. And that's what we look at every day. While August isn't a bullish month, we tend to see growth outperform. We tend to see some good areas. Now, these are industry groups, not sectors. Computer hardware and computer software tend to do quite well. So our scenarios, and again, this is just for Monday's session. We are going with the down scenario. We pretty much have to. All of our charts are pointing down, but we're oversold in the short term. And at the same time, support continues to hold. We're watching to see if those support levels hold for right now. We're not going with the up scenario, and we're not going with the sideways scenario because our ADX, even though it's weakening, is still well above 20, suggesting that we're in a trending environment. So the warning signs, again, this is just for Monday based on where we were on Friday. We did see a convergence of the short-term bearish signals. We were looking at a ratio between the S&P and the VIX. It was doing all kinds of crazy things. That was warning sign number 1. The 5-period simple moving average of the equity put call ratio started to go back up. That was another warning sign. We were seeing negative divergences in our different oscillators that we use. That was another warning sign. And we were also coming into a weak period, the latter part of July and the early part of August. All of those finally came together, and we saw the weakness that was witnessed this past week. The longer-term trend signals, those are the weekly charts of the S&P and the NASDAQ. Those charts might be signaling that we're at a top. We don't know right now. It takes a while for this to play out. So far, we're staying right near that resistance level, so we can say that support is holding. We'll see if there's any further weakness. We're coming into a seasonally and historically weak time of the month. That's the end of July and the first part of August. The S&P 500 oscillators have now turned over negative. The NASDAQ 100 chart that I showed you, it's also negative. The VIX is still showing that there's a lot of complacency. Now it's spiked up, but it's still giving us a pretty low reading. The cumulative new highs, new lows for the NASDAQ are showing weakness. We're above that 3-month yield on the daily chart that I showed you where we were at right before the great financial crisis in 2007. The S&P growth is weakening. That's more intermediate to short term, where longer term we're still in an uptrend. The weekly pivot has acted as overhead resistance. That was one of the first charts that I showed you. We went right up to that level a week and a half ago, hit that, and we've been coming down since. The parabolic SAR on the daily charts is negative. However, on the weekly charts, it's still positive. And then earnings season is coming around, and that'll be either positive or negative based on how companies report. The positive signs, we do have this seasonality in setups that I constantly allude to. I showed you those charts in this video. I don't show those charts in the daily videos. The long-term daily special K chart is still positive, where the weekly chart showing some improvement but is still negative. The longer-term equity put call ratio continues to be positive. It's declining, and when it's going down, that means stocks are typically going up. The S&P remains above the downtrend channel upper line, a chart I haven't shown in a long time because we're still far above that line. We're still in a risk-on posture, so folks are favoring stocks over bonds, even though this ratio took a bit of a hit this past week. Lower price levels may provide support, and so far that's been holding up. We're breaking through some areas here and there, but it might be on the NASDAQ, it might be on the NASDAQ 100, it might be in the S&P, it might be in the Dow. We just have to watch all of these levels and see if they continue to hold. The S&P continues to outperform utilities, which often gives support. The NASDAQ and NASDAQ 100, they're above longer-term resistance, but they're still below daily pivot resistance. That's where we topped out and started to come back down. This overhead resistance, if we continue to fall, will this provide some kind of support? The Staples to S&P 500 ratio is declining, which is often positive for the S&P. The Russell and the small caps, as well as the mid caps on the daily charts, have generated recent golden crosses. Small and mid cap growth continues to be positive, and mid cap growth is still holding up a bit better. The Pring bottom fisher is still generating a buy signal, and the financial sector has generated a golden cross. So our conclusion, now this just applies to Monday. The S&P is negative, and we're wondering, will support hold? In the short term, we're negative, but we're oversold. We're just plain vanilla negative in the intermediate term. And in the long term, we're still positive because we're above the 200-day simple moving average. Thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. Have a wonderful weekend, and I will talk to you in the next video.